Hello traders, welcome to my channel. I'm Arkhamtrades, and in this lesson we're going to be going over how I was able to turn $600 in funded challenges into $37,000 in payouts. And in this lesson you're also going to learn how to use proper risk management as well as trade management, mastering your psychology behind every single trade, as well as I'm going to give you guys my trading strategy and a free trading plan towards the end of this video with live examples to ensure that you see success. But before we begin, make sure you guys click that like button below. It only takes 2 seconds. Thank you. If you're actually serious about becoming a profitable trader, you have to focus on these 2 specific traits: your structure and your perspective. Your structure is defined by in which how you approach the markets on a day-by-day basis, and perspective is how you determine that progress. And it's summed up by this one quote: thinking long-term means to not allow the outcome of the day to determine your excellence as a trader, but the outcome of the month/the year following your process. What determines a good risk management system is a system determined on metrics, not money. You can have a great trading day and not make any money, meaning you followed your structure and your rules, yet you came out unprofitable that day. Yet you can also have a bad trading day but still make money. Even though you made money that day, you didn't follow your rules and you probably went on tilt. Your structure is what keeps you together. It's your trading plan that you follow on a day-by-day basis, and your perspective of how you approach losses. Don't allow a losing day or a losing week to result in the outcome of a failed trader. The results you're looking for is in the mindset of following your specific process on a daily basis. And if you don't have a specific trading plan, that's okay, because towards the end of this video, I'm going to give you guys a free course and a free gift. So stay tuned. When it comes to risk management, it is determined based on these 2 factors: your risk per trade and your maximum drawdown. If your maximum drawdown is 10%, you take 2% per trade. And if your maximum drawdown is 6%, you take 1% per trade. And if your max drawdown is 3%, you risk 0.5% per trade. Risk management is one of the most important processes in your trading structure because this is what makes or break you as a trader. Too many traders lack the understanding of proper risk percentages relative to their max drawdown. If your maximum drawdown is 3%, you cannot risk 1% per trade because every strategy has a period to where they encounter a losing streak or drawdown. And if you're risking 1% per trade, this only allows you 3 trades. And you can easily blow that account in a day or a couple of days. Have to be thinking on a conservative basis on how much you should risk per trade and think long term. When your max profit is 6% or 10% and you're risking 0.5 to 1% per trade, you're not going to pass your account in a matter of days or even a week. It may be 2, 3, or even a month before you pass those accounts. The goal of these prop firms is to make you rush, but the more that you rush, the more likely you're going to set yourself up for failure. You have to be trading these accounts conservatively. And an example could be you're trading 2 weeks and you still haven't passed. Now that's getting in your head. You're like, oh, it's been 2 weeks. I haven't gotten anywhere. I'm still at break even. I'm just going to take this one trade. I'm going to use max loss. Either I pass it or I blow it. And then you end up blowing your account in that same day. Focus on your process on a day-by-day basis, regardless of the outcome. Whether it takes you a month or 2 months, continue to follow the same process day in and day out. How do you set perimeters in place to ensure that you follow your systems? Well, let me show you. There are 2 ways to attack this. One way is more focused on conservative and the other is focused on aggressive. When it comes to conservative, you want to focus on small wins adding up over time, meaning you're taking 1 to 2 trades a day. And if you risk 2% that day, you're only risking 1% per trade. So the max drawdown is 10% and your daily risk is 2%. So if you're taking 2 trades in a day, you'd risk 1% on both trades. If your first trade is a winning trade, then you're done for the day. But if your first trade is a losing trade, then that permits you another opportunity to take another trade to make up that loss. And if both of those trades loses, you only lose out on the 2% that you initially risk. Now we have that aggressive approach, which is taking 1 trade per day, risking your daily risk on that 1 trade. Your daily risk is relative to your max drawdown. So if your max drawdown is 10%, you're risking 2% that 1 trade. And you're focusing on more of a aggressive approach, scaling into your winning trades, focusing on having a high R multiple with a 3 to 1 R on average. So we can have one side which is more focused on slowly building your account over time, taking 1 to 2 trades, and then the other account is focused on getting those really nice, high quality, high probability trades. On the aggressive approach, you're probably taking anywhere from 2 to maybe 3 or 4 trades a week, while the more conservative approach, you're taking consistent trades every single day, 1 to 2 trades a day, focusing on those small winners. Whichever route you take is based on your personality. If you're someone who prefers scalping, then you would take the more conservative approach, taking those small winners. But if you're more so of a day trader or a swing trader, you would take the aggressive approach and maximize on your winning trades on every single opportunity that you see is a high probability. And last but not least, you want to make sure that you're drilling your metrics. This is my account with a hint of both conservative and aggressive. And as you can see, every strategy has a period of drawdown where we had this drop right here, had this drop right here, slight drops right here, going higher and higher prices, right? Every strategy has a period of drawdown. During those times when you are in drawdown, you want to reduce your risk until you're back at break even. So if your max drawdown is 6% and you go down to 3% in drawdown, you want to stop risking 1% and start risking half of it. So I would then start risking 0.5% until I get back to break even and out of drawdown. Then I can go back to risking that same 1% instead of trying to throw a Hail Mary or something to get back to break even, because that usually doesn't work out on the long term. We want to be focusing on proper risk management and executing on our systems on the long-term basis and not trying to gamble on it day by day. Now that we have everything out the way, I'm going to show you guys my exact strategy, as well as towards the end of this video, I'm going to give you guys my exact training plan and free course. So make sure you guys stay tuned for that. Before we get into that, if you guys want to be a part of an elite community, access to 30+ hours worth of in-depth content, daily live trading, weekly progress calls with all of our students and Q&A, as well as full access to not only me, but also my brother SpecTrades to ensure that you become profitable, click the link below and join Spark Trading University. And right now we have an offer that if you join Spark Trading University in your first year and you don't see any results, me and my brother will personally coach you one-on-one until you become consistently profitable. That's going to be a first link description. Make the investment in your future. Back to video. When framing a narrative inside the marketplace, I like to refer to two things: overall structure and higher time frame support and resistance. So we're looking at the 1 hour time frame here, and some key things I want to take note of is this volume imbalance here by this gap. So we can see we have this 1 hour support level. So price came down into this gap level and it's seeing this rejection wick, right? Given by this wick rejection to the upside, this is showing that as price came down into this gap, buyers started coming inside the marketplace, pushing price back higher, giving this long wick here, as well as we did take out a prior low, marking this as a level of liquidity, as well as this prior low as well, another level of liquidity. So how I'm framing a bias on a day-by-day basis is very, very simple. Are we at a higher time frame level of support resistance, and is there opposing liquidity above us that we can then target? We're clearly at a level of support right here based off of this 1 hour gap. Plus we do have levels of liquidity above us right here. So we have our level of support, we have our overall structure. Price came lower to tap into the support level to then potentially see higher prices that take out this level of liquidity. Now the third thing I want to incorporate is time. I'm going to wait until the market opens, show me that price is finding support here, and how I can identify price finding support here, see how does price react at this specific level, and if we can get some type of breakout to the upside, I can then capitalize on that long opportunity, reaching back above higher prices. So we're using the higher time frames in terms of overall structure inside the marketplace, as well as higher time frame support and resistance level, and we're using the lower time frame simply as a measurement of entry based upon our respective time. So 9:30 is about to open up, which is the stock market exchange open for the Dow Jones. Seeing how the market opens up, pushes lower, but not willing to continue lower, instead starts reacting back higher, that is a good indication that buyers are then buying at this specific levels and sellers are then getting exhausted, to where we can capitalize on our long opportunities here, continue to see the marketplace push higher and higher prices. Let's see how 9:30 opens up and how we can frame our entry. We can see the 9:30 opens up, comes lower, giving this reaction to the upside. This is the perfect reaction that I want to look for. I want to be long either inside of the wick or near that opening price. In this specific example, I did take this trade exactly, and I did take my long entry just at the height of this gap, and I had my stop loss just back below this previous low, essentially back up into this order block level for about a 3-to-1 R. This was the exact trade that I took with my live train students, and let's see how this plays out. Seeing the reaction I was getting, I actually did end up scaling into my position right here as the marketplace opened up. Like we mentioned, opened up, comes lower, I want to be long inside of the wick or near the opening price. So in this case scenario, I was long inside of the wick here, and I adjusted my stop loss back into my original entry. In this original entry, put it back to break even, reaching back above higher prices, maximizing on my winning trade. I'm taking one trade a day, but that one trade will yield me a lot of money because I'm maximizing on my wins. Let's see how this trade plays out, reaching back up into this order block level. And we can see price comes all the way back up into this order block level, making me a little over $8,000 in just 30 minutes. And if you guys want to see the exact execution, it's on my Instagram at Arkhamtrades. Every single morning I post my wins as well as my losses. So if you guys want to keep up with that, that's going to be a link in the description. And looking at our next example here on the Dow Jones, the exact same framework. We're on the 4-hour time frame, and we're identifying levels of support and resistance as well as overall structure. So we can see on the higher time frames, we are seeing lower and lower prices. So the overall structure inside the marketplace is we are in an overall downtrend. We can identify this bearish fair value gap as a level of higher time frame resistance. As long as price is inside of this higher time frame bearish fair value gap, I cannot be in a position to where I'm looking for longs. Instead, I have to be in a position where I'm anticipating price to find rejection from this level. So we're utilizing the higher time frames based off of structure as well as support and resistance, because those hold true the best on the higher time frame. The lower time frame fair value gaps and things like that, they don't work out a lot of the times, but on the higher time frames, they work out a lot of the times. So you guys want to be maximizing your probabilities on every single setup. We're going to go down to a 1-hour time frame and get more context. So on the 1-hour time frame, I can identify this previous high as a level of liquidity that we then taken out, tapping into this level of resistance, and I can identify these lows as areas of liquidity as well. So just keeping things very, very simple. We are at a higher time frame level of resistance. We've just taken out levels of liquidity. If we can see a lower time frame break respective to our specific time that we are trading, then we want to be looking for shorts reaching back below lower prices, keeping things as simple and as smooth as possible, guys. Let's go down to a 15 minutes time frame and see this in action. So we're now on the 15 minutes time frame here, and I can identify that higher time frame bearish fair value gap as a level of resistance. We took out this previous high as well as a level of liquidity. So if we can see the marketplace reach back up into this level, I would then anticipate a short reaching back below lower prices, keeping things very simple and robust, following the overall structure of the higher time frame and the overall trend, and taking our entries based off of higher time frame levels of support or levels of resistance, or targeting opposing levels of liquidity, either internal or external liquidity, keeping things very simple and robust and repeatable on a day-by-day basis. Let's see how this plays out. So as the marketplace went higher here, I took my short when price came back lower, giving me the signal that was going to be a rejection. I put my stop loss back above the 75% of this bearish H4 fair value gap, reaching back below these London session lows for over a 3.4R. And if we can see the marketplace reach back up higher into this level and see another break lower, I want to scale into my position to capitalize on my winning trade. So as we get this bearish engulfing candlestick, leaving this last up close candle right here in the form of this bearish order block on the 15 minutes time frame, I then scaled into my position right here, adjusting my stop loss back above this previous high, reaching back below lower prices. We can see price came higher once again to take out this previous 930 high. Then we get this bearish engulfing candlestick, giving a change in state of delivery below this last up close candle. So this would then be a high probability order block. So as long as price can remain below this last up close candle, we can see a continuation lower, reaching back below lower and lower prices, continuing that higher time frame trend. So I can frame my entry based off of the higher time frame level of support resistance, and then I can scale into either the order block or the inversion fair value gap, capitalizing on this trade, once again making me a little over $8,000. In this case scenario, this did span out for over an hour, but it was well worth it. And if you guys want my free course as well as free training plan, that's gonna be the link in the description, as well as my free ebook. And if you guys want to be a part of an elite community inside of Spark Trading University, we do daily live trading, weekly progress calls, and Q&A with all of our students, as well as we have over 60 plus lessons, 30 plus hours worth of content to ensure that you become a profitable trader. And if you guys do not see consistency within your first year, we will personally coach you for additional 3 months for completely free until you become consistently profitable. That's going to be it for a video. I'm Arkham. Be safe.